One of the biggest fears that retirees face is running out of money. The potential of annuitizing a portion of retirement assets to address this challenge can be really compelling in some circumstances. So today, we'll cover key benefits of annuities, the trade-offs you should consider, and how to decide if this approach fits within your retirement plan.
All right, so Spencer, today we want to talk about annuities and where it can fit into certain clients' retirement plan. So before we begin, let's just start off with the basics. What is an annuity? What do we need to know are the key elements of an annuity?
Well, one of the things that we want to first acknowledge up front is that annuity is a four-letter word in financial media. And there are reasons for that. So if you have a knee-jerk response to the word annuity, you're not alone. And there are reasons for that. One would be that sometimes the commissions and fees are high, on those. But one of the things that an annuity can do, again, is help us deal with that lifetime income. And the way that that often happens is you take a portion of your funds and you earmark them to create that income stream. It can be for a set period of time, for a number of years that isn't for a lifetime, but oftentimes it is for a lifetime. There are different provisions. Sometimes you surrender the entire value, lump sum up front. Sometimes you still have access to those funds, but there is a surrender charge in a certain period. So there's lots of different types and flavors here, but the big picture is that we are looking for a long period of time to guarantee some income so that we're not running out of money.
Right. Well, and another key piece is it's a contractual agreement between yourself and an insurance company. So you're doing one-to-one business with an insurance company. Now, the insurance company was going to go pool the resources against everybody else, but the agreement that you make, the guarantee, the promise to pay, is based on your investment that you make with the insurance company and their contractual agreement to you.
Right.
So then what does it mean to annuitize a set of funds?
If you actually annuitize a set of funds, most people would use this term to say we're taking that lump sum of resources. So let's say you take a couple $100,000 and you convert that into a lifetime income stream. So let's just say you're in your mid-60s, you take a couple $100,000, you want to make sure that in addition to perhaps Social Security, that you have some other income every year for the rest of your life. If you annuitize that, depending on the terms of the annuity, it may mean that, well, if you live 1 year, that you only get 1 year's worth of income. But if you live 40 years, you also get 40 years worth of income. Right. So it's basically trying to address in the most efficient way that need for a lifetime income stream, because you might imagine if you convert that, then on the long side of things, you're being able to protect that income stream for life. Now, of course, there are situations where if you passed away prior to life expectancy, that you would get less than what you would hope for. But again, it solves that key concern of, will I have enough each year to live on?
Right. Okay, so let's then walk through a couple different types of annuities. We've got immediate, deferred, fixed, variable. Just walk us through some of the basics of each of those.
Yeah, so an immediate annuity typically would be one where you take that set of resources and you're starting the income stream immediately. So really, really creative language here, but the income stream starts right away. A deferred annuity would be one where the income stream doesn't start right away. It's deferred for some period of time. So it might be deferred for a year or 5 years or 10 years or some other period, or it might be a period that you can make an election on each year. So there are different ways that you could look at that, but the farther that you defer, typically the higher the level of income will be once it begins.
Right. Okay, and then the difference between fixed and variable.
So a fixed annuity often would be one that has payments remaining constant. A fixed annuity may be one where the actual interest rate remains the same, and at the end of the annuity, you have a amount that is available to you. So it might not be for life there. If you have a lifetime income stream that is an annuity, a fixed would be one where typically you have the same payments that are coming month to month or year to year from that annuity. As the name implies, a variable annuity would be one where the value of the annuity can fluctuate. It can go up and down. It can also mean that the payout level can go up and down over time. Now, that's not always the case, because there are variable annuities out there where the value goes up and down, but there is a set income stream for life that remains constant, provided that certain elements are in play. there. So there's a lot of complexity here, much more so, I would say, in the annuity space and these payouts and different riders that can be added than in a lot of other types of investments.
Okay, so a lot of it, we really have to take a step back and say, not all annuities are the same. And you really need to get into the contractual language that the annuity provider is offering. So let's go ahead and talk about what are maybe some key benefits of the potential of annuitizing retirement assets.
We go back to the first one that is really the key, which is if the highest fear among retirees is running out of money, then an annuity can help to provide income for life. And there are lots of different ways that that can work. Some of them, it's a surrender of the entire lump sum that might go into the investment. For others, it is maybe having those resources locked up for a period of time. But the biggest is that longevity protection. Because when we sit down with folks and they're in their early to mid 60s, we don't know if they have a week or 40 years. That's a big, big question mark, a big variable. So this can help to address those fears, number one. The second piece is not just addressing those fears, but doing so in a way where there is a level of stability. So oftentimes these companies, and not all of them, but a lot of these companies, they're incredibly strong financial companies with really, really high ratings. So they could certainly still go under. But most of these annuity companies, they have a significant financial strength. And so that stability of income, it would really take kind of an apocalyptic event for them to go under. Now, is that a guarantee? No, it's never a guarantee. But that stability of income is a key draw. A third thing is that it simplifies management of resources in some ways, because if you say, okay, well, I need, let's just say I'm married and I have $5,000 a month of Social Security coming in between my spouse and I, and we feel like we need another $5,000, roughly speaking, to have kind of base spending levels. Well, in that case, rather than trying to have a diversified portfolio and know where to take withdrawals from and rebalance and all these different kinds of things that we get into on a day-to-day basis, for some folks say, well, I'd like to take a portion of those resources and I'd like to make sure that I can use those for that income that I need. And then everything else, maybe I feel like I can live and give with whenever I want to. So it can simplify the decision-making process in that people feel like they've got a level of stability in some of the core expenses while being able to use those others to do living and giving at whatever pace they may want to. Another piece is that it protects against market downturns. One of the things that no one wants to be beholden to is the stock market. We don't want to think, can I take that trip just if the stock market does well? Can I go to a place that I've always wanted to go to, or can I make that gift for grandkids' education or what have you, just if I get a 10% rate of return in stocks or something like that this year? Instead, we'd like to be able to have our financial goals met in a more consistent way. And the consistency of the options here can help in some of those goals.
Yeah. Okay, so we've talked about a lot of the benefits there, and those seem great. What are maybe some of the key trade-offs or the downsides of annuitizing retirement assets?
Well, you lose control of those assets. You lose a level of liquidity, certainly. So if you make an investment and whether you actually trade that investment, you move that into an annuity and annuitize those resources where you're actually losing entire control of it and you've got a lifetime income stream, or whether you just put the resources there and there is a contractual agreement that the annuity company will pay out a lifetime income stream, but you could still pull those resources back maybe in a number of years, maybe with some kind of surrender to them, surrender charge to them. There's a lack of liquidity there. It's not as though you just made that investment and now you can do whatever you want with it. At the same time, there's that loss of control. In some circumstances, you have no capacity to get those resources back. So it can be one of those situations where you can feel powerless if, say, you annuitized resources and you did so thinking, well, I'll probably have several decades of income from this. Well, if you visit the doctor the next month and your life expectancy changes a lot, you're not going to probably be able to change some of those decisions that you might have made. There's a lot of different types of investments where if you annuitize, you completely annuitize and you get a lifetime income stream, the income stream is going to be higher than it would have been otherwise. But if something comes up, it may be hard to get the full value of what you put in.
Right. All right. So Spencer, we've talked about loss of control. We've talked about the fact that if you lock in your money and you annuitize it and you die in the next week or two, that may not be a great option. There are some other downsides that we have, like high fees and commissions and potential for lower returns. Can you talk us through those?
Well, historically, insurance companies, annuity companies, they have employed a sales force that is driven by commissions. Mm-hmm. And so there are still those situations out there where the real driving force is the salesperson trying to get a client to make a decision that would lock them up for a long period of time, and that there would be a significant commission, there would be high fees associated with that. Now, sometimes those are rather opaque because these annuity contracts can be very, very dense literature for reading. I mean, we're talking dozens, even hundreds of pages sometimes, with terms that the layperson sometimes has trouble determining what goes where. Mm-hmm. And so there might be a lack of transparency or a lack of capacity to understand at a deep level what the fees are and how those would compare to other types of investments or places that money could be put. So we have to be really careful on that. And there's no perfect solution here. We do work with a firm called DPL that is really focused on keeping the commissions and fees very thin for annuities. But there's still, you've got to read the fine print on anything that you go towards there. So that's certainly one for buyer beware. When we think about the potential for lower returns, you also think, okay, this annuity company, this insurance company, they are guaranteeing a lifetime income stream. They know that if they have 1,000 clients in a particular tranche of investment, that some people are going to die earlier, some people are going to die later in that, but they have to be fairly conservative in the way that they invest those funds because they know that they're going to have payouts at different periods. They need to have some growth, but they can't have too much risk in that portfolio of funds, again, because they've got lifetime income streams that they've got to deal with. So you may not have, if you have a variable annuity, for instance, with an investment, you could have fees that create a headwind, or to your point, if you have a fixed indexed annuity, you could have a range of outcomes there that's fairly tight, that you have a low of 0, but you also have a high that might only be 4 or 5 or 6% there, depending on the type of index that you're tracking and the terms of the contract. So oftentimes with an annuity, again, we're playing it safe. We're getting this lifetime income stream. The value of the assets that we exchange for that lifetime income stream, there are probably going to be some headwinds on those. They're not going to grow oftentimes at the same clip that, say, the stock market would if the stock market is going up at a really nice, aggressive upward point, but they're also going to cap the downside size risk there. So there are the trade-offs are what we have to deal with.
Right. Okay, so we've talked about some of the benefits. We've talked about some of the downsides. There are times that it makes sense to annuitize some of these assets, and you've kind of already touched on them. When you're concerned about outliving your assets, when you want that guaranteed income stream, are there other reasons where this really makes sense for clients?
Well, a classic example here would be if we know that we want a certain set of income over the course of time, and we have other assets that we would really like to deploy in the near term. So let's just say we have a client that they have $2 million of investment, and they want to make sure that they have $60,000 a year of income for life in addition to Social Security. And let's just say that, lo and behold, the annuity company that they're looking at can give them, for $1 million of a lump sum investment, can give them $60,000 a year for both of their lifetimes. Okay, great. We've checked off that box. Let's just say that their other chief desire is that they have $1 million to give to people and charities that they love in the next 5 years. Okay, well, that's a very noble thing to do. If we had those clients come to us and say, okay, I have $2 million, I don't want to outlive my assets there, and I've got potentially 30 years, why it would be very difficult to take $1 million and to be able to distribute that in the next 5 years if we didn't have the level of security of that annuity. Now, again, nothing is perfect and nothing is guaranteed, from ever, running out or not working. But if we can take that income stream and we can say, okay, this is what we're using over here for lifetime income, and now we've got flexibility with all of these other assets, that can be a great fit.
Right.
Of folks, again, particularly that want to accelerate a level of living and giving early in retirement, and at the same time don't want to sacrifice having that guaranteed lifetime income.
Right. Okay, so one of the last ways that we would consider an annuity is if we have clients that are very risk averse. So talk us through why that's important.
Well, if you think about it, let's just say we have a client that is terrified of the stock market, says, I don't want to see the ups and downs of the stock market. I mean, we've had 2 periods here in the last 25 years where the stock market, basically half of its value or more, disappeared over a matter of months. We saw in the COVID lockdown, the stock market get cut by about 1/3 within a month time. So there's going to be ups and downs in the stock market. We have folks that sit down with us that say, I'm just not sure that I really want to invest any in stocks. The trade-off is that if we've got 25, 30, 35 years of time that we want to guarantee some level of income, or we want to make sure that there's enough, that they're not running out of funds, if we're only garnering a rate of return that might be what you would get from money market or CDs or very conservative bonds, oftentimes we get to the end of that curve and we say, okay, it either hasn't been very efficient in that we've earmarked more towards basic spending than would be optimal, or there's just not enough. So that longevity protection that an annuity can offer can be quite helpful in a circumstance like this, because again, they might say, well, a rate of withdrawal might only be something like 4% on CDs if they don't want to tap into principal. Right now they may have that anchor, to them, but they may not have enough, to only take out 4 or 5%, per year. If a portion of their resources are annuitized, oftentimes that level of income can be far higher. It might be 6 or 7 or even 8%, depending on their age, the level of income relative to what's annuitized there. So it can be just more efficient in making sure that they've got lifetime income. Now, the trade-off, of course, in that situation is, well, what happens if they pass away in a year, but they've annuitized that lump sum? Well, most folks say, well, everything else is going to go to my heirs and there's not as much, but oh well. So you do have to get comfortable with that trade-off, but a lot of times for folks that are really risk averse, if we can guarantee lifetime income, then it gives them some space to do some other living and giving that they might not have had otherwise.
Right. Well, and that comes back to the big question that you can always ask: how much should you convert to an annuity, or how much should you annuitize? And I think this is where we have to come back and say, every client, every investor is unique, and every essential spending, every amount of percentage is going to be unique. And so there's never going to be a one size fits all. This is the right amount to annuitize for you and for your specific situation. But we would always come back to, what are those goals? What are your desires for your living expenses? And really working with a financial advisor that's going to walk with you through those things. But any other considerations of when we think about how much to annuitize that we would really want to let the viewers know?
Well, I think the key again here is an annuity. Not everybody needs an annuity. It doesn't make sense for a lot of folks. It needs to be in the context of an overarching financial plan. There are folks who look at the trade-offs and say, I'm really drawn to this for a portion of funds. It might be 15% of their funds. It might be 20 or 25% or even 30 or 40% of their funds. But it needs to be in the context of their financial plan. There are a lot of other folks that it just doesn't make any sense, to explore this. And if folks have a shortened life expectancy, oftentimes it doesn't make any sense at all to explore this for that reason alone. So we have to be really, really careful as we think about lifetime income streams, how best to help clients enjoy, retirement, be able to have that level of confidence and rest in retirement where they have a good sense of where income is coming, and be that through withdrawals in an investment portfolio or an annuity, it just needs to line up with the rest of the plan.
Great. Well, clients, if you have any questions about whether you should annuitize part of your resources, we would love to have that conversation with you. Always feel free to leave comments down below, and we'll see you again next time. If you like these financial planning videos, please share it with a friend, and if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.